Let's quickly switch over. We have Abhay Agarwal with us of Piper Serica. Welcome on the show, Abhay. Let's quickly talk to you about how valuations are looking. Overall, you're seeing the US 10-year roughly at 5%. So you're seeing a risk-free roughly at 9% thereabouts. How should one look in this environment for value, and how are you looking at the market valuations at the moment?
Yeah, thank you for having me on the show. Good afternoon to you and your viewers. So I think a couple of things, if we put them in perspective, is that first of all, as you mentioned, the yields not only in India but in the US and global markets are going through a decadal or multi-decade high now, and they are not stopping. And one of the reasons for that is that finally investors are asking to be paid more for lending to perennial borrowers, including the US government. So I don't think it is anymore a question of the inflation rate being high and sticky, and that is why the Fed holding rates high. It's just that now there is lesser and lesser liquidity globally as some of the investors are taking money off the table and asking for higher returns on the loans that they make to borrowers. So in that context, when the interest rates are going up, the immediate corollary is that price earnings multiple should fall for equity markets. And that is the part which is baffling market participants because that is not happening. In fact, you see the Indian market, emerging markets generally, you look at the US market, they've held up pretty well in a scenario where the interest rates are at 2-decade high. So it is causing some discomfort to long-term investors, including us. What we have done is we have made our portfolios more defensive. We have booked profits in short-term and small cap and mid-cap stocks in our portfolio. We had a 75% allocation. We have reduced it now to 50%. We have increased the weightage of large caps. We see more value there, and we are holding some cash. So our long-term call on India is still very robust. We believe India will outperform all global markets over 3 to 10-year period. But in the short term, we're just looking at what is happening at macro level globally and getting a little defensive in our portfolios.
Right, getting defensive in portfolio. Now let me try and break up with regard to your large holdings. Your largest holdings, I can see one of them being ITC. Of course, it's been a solid stock in terms of the way it's given returns. But do you see some kind of a peak coming through, or do you see a bit of a flat line in terms of returns in at least the short to medium term? How should one look at valuations at the moment?
So I think ITC is a stock which is probably, if I look at the large cap defensive universe, the most defensive stock, as I would call it, because of a couple of reasons. One, high degree of certainty of revenues, negative working capital, almost negative working capital, giving back money now regularly to investors in form of dividends, and then pretty much all their businesses are firing, and the FMCG business has actually surprised a lot of people on the growth and the margins that they have generated and they continue to do. So our view is that we don't have a short-term call on ITC. We believe that with about a 4 to 5% allocation in the portfolio, we are happy to hold it. Even if the market's correct, we don't expect that because of its comparatively lower valuation to the FMCG segment. I don't think it will suffer so much. So for us, it's a good defensive bet that we plan to continue to hold. And I believe as their numbers continue to improve and they probably, hopefully, will do some more shareholder-friendly activities, we expect the valuation also to re-rate upwards.
And the other name which has come up with regard to your recent additions is Geo Financial. So how do you see the story play out there? Because at the moment it's trading at roughly 3 times price to book, which is probably more expensive than even an HDFC bank. So how should one look at a Geo Financial in terms of its business, in terms of execution capability, as well as in terms of protecting loan book and lending to the right people, right? How should one look at it?
So let's start with the valuation first, since that's a great point that you made. There is a lot of confusion in the market even now with very seasoned analysts that what is the real book value multiple of Geo Financial Services. Because if you look at yesterday's presentation that they put out, they have put the book value at 1 lakh 16 or 18,000 crores. And which means that current market cap, the stock is trading at less than 1.5 times book value. But then there is a school of thought that says that, look, a large part of that book value is the treasury stock of Reliance. So that should be discounted, and there should be a holding company discount given. And if you reduce it, then the book value multiple goes closer to 2.5 times. So the way we look at it, and the reason that we added the company is that in India there is a gigantic size opportunity, that is already there, and it will continue to grow as the economy formalizes pretty much every day, every month, every year from here on. And there is a large unmet need for financing and asset management on both sides. So, I'm not looking at Geo Financial Services only as a lending play for consumer lending. I'm looking at it as a full financial services company that has an asset book and a liability side also. So if you put this together, then there are a lot of advantages that it has. It has probably one of the largest book values in terms of rupees crores in the Indian industry. It has already, through the group companies, retail and telecom, a very large retail presence, almost 45 crore telecom customers, 15 crore retail customers. So they already have this dominant position as far as market standing is concerned. So then the Geo Financial Services, all the products are, when they hit the ground running, it's going to scale up very, very quickly is our bet. And the third bet that we are making is that they will use technology, and that's what Mr. Kamath has been saying regularly, is the use of technology to drive pricing downwards, without sacrificing margins. And I think that is where there is a great opportunity for them to work with startups, behave like a startup themselves, use technology, take out a lot of frictional costs, improve credit quality. So for us, it is a 5-year bet that we are quite hopeful of.
Point taken. Let me quickly switch focus. You spoke about it being a market of defensives is the way you're playing it. So let's talk about pharma. Let's talk about IT. Those are possibly two defensives that one can talk about outside of FMCG, where you already spoke of ITC. So how are you looking at, what kind of names are you looking at in those spaces, and what kind of trends are you seeing in those spaces play out over the next couple of years in your view?
So in pharma, we have one stock in our portfolio, again, not a buy recommendation. It is Divis. And I think in terms of pharma, a lot of price correction through sideways price movement has already taken place. Multiples have come down, and we are seeing some pricing power for large generic exporters also coming in, though it's still quite competitive because China is a constant supplier, and if I can use the word, dumper of commodity products at unpredictable prices. So assuming that China threat abates over a period of time, I think the large Indian generic exporters will do well because they have now created efficiencies of scale, and their margins should improve from here on. So on the whole, looking at the current valuations, we are turning positive on the large pharma exporters. Still not very clear about the smaller companies, but definitely the large companies, I think, will scale up, and China and India will become an alternate to China as far as bulk drugs and generic exports is concerned. And then there is the other segment, which is the CDMO, CMO segment, which is contract manufacturing. And I think that is where India's next level success will come, when it marries its good quality manufacturing with a large international market. And I think companies like Divis are at the forefront of that. They have been working very hard for last 10 years almost to build a very robust CDMO business. So I think if we look at the pharma space, I think it's a very interesting space that has been neglected by the market for a very long period of time just because it hasn't done anything. And I think it is probably forming a cyclical bottom now. The valuations are attractive for what it can generate over the next 5 years. So overall, we are quite optimistic of pharma companies, and we have seen the price run-ups also recently. So I think the market is also catching on slowly. On IT services, we are still fairly negative because I think the IT companies will probably go through a year of very low growth, if at all, constant currency growth of top line, and they will probably go through some margin compression also as they have to finally take some cost increases in terms of rents and wages. So we don't have any IT stock in our portfolio, and we are not looking to add any shortly.
Right. Thanks so much for that, Abhay. That's all the time we have today. But it's been a pleasure interacting with you, and thank you so much for giving our viewers that perspective. But with that, we